Hello and welcome to Portfolio Perspectives with me, Tom Santa-Olalla. Now, we recently hosted our annual charity funds review, and the event brought with it some really interesting questions from our attendees that we felt were really quite pertinent across our entire client base, whether it's charities, private clients, or institutions. So we thought we'd take the opportunity to explore some of those key topics with one of our investment managers. So we're going to be looking at what's been driving portfolios and broader markets, what's the state of the AI trend as it currently stands, and risks and opportunities within portfolios looking ahead to 2026. And I'm joined today by one of our investment managers, Tom Kynge. Welcome, Tom.
Thanks, great to be here.
Let's jump straight in. We've just come through reporting season. How have companies fared this time around?
Yeah, so broadly speaking, it's been a good earnings season. So companies globally have done better than expected, which is good to see. Even more encouraging for us, our companies that we've invested in have done slightly better than the market. So if you look at sales growth over the last year, our companies have grown sales by 14% compared to the wider market at 6%. That's the same for profits, where profit growth has been 17% compared to the wider market at 15%. So a pretty good result for us in that sense. What we have seen, though, is some companies have been calling out slightly concerning outlooks for the consumer. This is particularly true in the US, but broadly a good set of results with some concerns in some places.
Okay, so a reasonably supportive backdrop and companies performing well fundamentally, but haven't necessarily been rewarded with share price action that you might expect. So what does that mean for portfolios looking ahead?
Yeah, so I think that's a fair comment. We have seen that our companies are doing better fundamentally, but not being rewarded in the same way with share price reactions. But in a sense, I do think that provides us with a bit of an opportunity. So the way that I would conceptualize that is if you look at the quality valuation premium, which is essentially what investors will pay in terms of a premium for higher quality companies, that premium has really collapsed over the last 12 to 18 months to well below its 10-year average. So we're essentially able to pick up companies we've liked for a long time at relatively inexpensive levels compared to the rest of the market. So in that sense, it's an opportunity for sure.
So very much sticking to our guns, seeking out those quality thematic companies.
Absolutely right. So it's embedded in our long-term investment process. To put some meat on the bones here, if you look all the way back to 1990, you can see that quality companies tend to outperform by 2 to 3% a year. So that gives us reassurance that we're facing in the right direction. When you combine that then with our thematic process, which identifies structural growth trends in industries, but also companies, we think that gives us the best opportunity to perform for the long term.
Okay, and one of the risks that's very much at the forefront of many people's minds at the moment is whether or not we might be entering or already in bubble territory within the AI space. What are your thoughts on that?
Yeah, so we recently did a deep dive on this area and have concluded that while there are pockets of exuberance in the market for sure, we do see that the AI-driven trend can continue for some time. What really reassures us is for the large part, these AI-exposed companies are being driven by revenue growth rather than valuation expansion. Having said that though, there are definitely areas of the market where valuations are becoming a little bit extended, signs of hype and speculation, and so we're avoiding those areas, trying to be selective when we pick our portfolio companies. So to give you a precise example, unprofitable technology companies are very expensive at the moment, so we're steering clear of those.
And historically, bubbles tend to have been sort of funded via debt. Is that the case this time around, if we were to be in a bubble at all?
Yeah, so for large part, the capital expenditure so far has been funded from cash. The hyperscaler companies, otherwise known as cloud service providers, companies like Microsoft, the Google parent Alphabet, and Amazon, generate huge amounts of cash flows, and it's really that cash that's being used to fund this capital expenditure so far.
But we have seen some companies issuing quite large bonds, Microsoft, Meta, for example. Is that a concern in any way?
It's something we're watching for sure. It still makes up a relatively small part of the capital expenditure funding we've seen so far, but something we need to keep an eye on. You will have also seen that there are more interconnected deals in the last few weeks than we probably would like to see, and so we're keeping an eye on that as well.
Okay, and I suppose actually risk goes both directions, doesn't it, as well? Because there's also the risk or the opportunity cost of not participating when you see one of these growth trends. And given that you feel that there's still potentially room to run on this, we wouldn't want to jump off too soon.
Right, and that fits very neatly into our long-term regimes framework. So we do see that AI, regardless of what's happening in markets with valuations, we do see that there's going to be a real transformationary effect on the global economy. So in the short term, you'll see capital expenditure supporting economic growth as it has done in the last few years. And then in the long term, we do see that it has the power to increase productivity and perhaps be a disinflationary force. So we'll have to consider that in the broader inflationary picture as well.
Great. And well, let's change direction a little bit. We've just had the UK budget. One of the areas of the portfolio that's particularly exposed to the potential outcomes of that budget was the fixed income market. How are we managing that side of the portfolio?
So we've been cautious on fixed income for some time. I mean, what we've identified through our regimes framework is that we are entering into a higher inflationary regime. So although bonds do provide you with some income and yield for those investors that require it, it does mean that they're not going to work as well as a diversifying asset compared to your equities as they have in the past. So for us, the budget didn't really do anything to change that. So we remain cautious on bonds with a preference for equities for growth and assets like gold for diversification.
Okay, and let's finish on something positive. What's giving you optimism for 2026?
Yeah, I mean, I think there's a lot to be positive about. As I've mentioned, we have a great portfolio of companies which are generating better fundamental performance than the rest of the market in terms of sales growth and profit growth. We also see that the global economy should be relatively robust, supported by higher government spending, but also the spending on AI capex, as I've discussed. And then finally, the areas of weakness that we do see, particularly the consumer, should be supported by some interest rate cuts if and when they come through. So all in all, a positive outlook and I think a good period ahead.
Tom, thank you very much. That's been really helpful. And thank you for watching. And if you'd like to hear more about our views on the macroeconomic environment, please do tune in to Guy Munson's next 6-minute strategy. Thank you.